All right. Hello, everybody, and welcome back to another episode with Sharp Education. Today's episode is going to be informative. I always keep it informative, but it's going to be a bit of publicity, a little bit of an advertisement for the model I use. Not directly, I'm not just going to be telling you to buy it, but it will be explaining the benefits of how it works if you're not too clear on SharpEdge, which is my artificial intelligence model that gives you an advantage in identifying opportunities that turn this green line here positive. Um, so I just buy and hold all of the stocks provided by SharpEdge at the beginning of the quarter. Let me show you what that looks like. So if we go to previous ratings and just click on any quarter, I'll do the second most recent so I don't show you guys the proprietary stuff. You can see that these stocks receive higher ratings and they do well on average, and the lower ratings do poorly. So these ratings are given to the stocks at the beginning of the quarter, and all I do is just hold the top 10 for the 3 months that they are listed each quarter. That is not, the recommended standard way to do it. It's just the way I do it, so I have some skin in the game without overcomplicating the results of this model. And you can see that when you get really high ratings, you on average get really high performance, really good performance. And over time, these results compound to outperform the S&P 500. Now, this positive drift is what the whole game of the stock market is. It's not a good risk to reward ratio. It's not patience. It's not discipline. It's just identifying upwards movements. And that's what this model does. So the way I am going to demonstrate how this provides like a clear advantage in trading is it changes the asset that you will be trading on if you choose to trade with these ratings. So you would be avoiding distressed and weak stocks that generally do poorly or have a low or negative average drift. But you could also replace that with a positive average drift on average. For example, I'll show you guys, instead of just these bar charts and line charts, like the actual Excel sheet that stores all of this information of the average movement of each of these categories. So here is the performance of each category by quarter. So it's been live for 8 quarters now, and the average performance of these stocks, of the premier stocks, is 8% in 3 months. The average for each category, escape Control R. We got 8%, 9%, 3%, 3%, 2%, and 0.4%. So, of course, all of these have positive drift, and that's the benefit of holding for longer periods of time. I don't recommend holding for short periods of time, especially within 1 day, because we've shown that by restricting our holding period to 450 minutes or 1 trading day, let me go back to our code. By keeping our time period to 450 minutes, this will significantly reduce your win rate because it's giving us less time to encounter our stop loss or take profit given the random variance that occurs in the markets. There's a lot of differing opinions, so stocks go up and down they go up and down in a non-predictable manner. So what provides an advantage is 2 things: setting this mu not to be 0 and setting your holding period to be longer. So, for example, if we had a mu of 0 and I wanted to hold for 3 months, so that would be 450 is 1 trading day. Then there are 21 trading days in a month. And then there are 3 months in a quarter. So if we ran for that much time, with 1,000 iterations, it's going to take a bit longer. What I'm going to want to see is our theoretical win rate probability equaling our simulated win rate probability. But we already know by now that the estimated value is going to be negative because we're capping off the likelihood of randomly encountering our really high risk to reward ratios is so much slimmer than being stopped out. So even when we do encounter this, the expected value of our simulation becomes like negative. And when it's not negative, it's pretty close to 0 before fees. So you want to be doing something different. And So now we have step one, which is prolonging our trades. That's really important for getting our probability at least similar to the theoretical or simulated probability. But what we want to do is be increasing this drift. So how can we increase this drift? Let's go back to our Excel sheet where I took the average of all of them. Let's move here, Excel. So if we want to do the average daily drift into minutes, so this will be tricky, but I think we can do it. It's going to equal this divided by 3 months, divided by 3, divided by 21, divided by 450. So this should give us our average minutely drift, 0.00002. And we're going to do this for each of these categories. Control R. And now we have the average drift that we're going to be incorporating into our trading strategy that we can assume now. Really interesting. Remember, if we don't know what our asset is going to do, which we don't if we're using technical analysis because it's a retrospective and we've already covered a lot of episodes on that, then we kind of need to keep this at 0 to be effective. Until we have a strategy with a track record of being not 0, it's safest to keep that at 0 and only replace it with the proven results of a strategy that you can identify. So this is 2 years of documented results. So I'm pretty confident that I can put this 0.0002 into my standard drift per minute for the premier stocks. And I almost forgot, I need to divide this by 100 because these are in percentage terms. Okay, so if we take these values from our Premier Strong and Reliable's average minutely shift that we did using some basic division, then this can increase the expected value of our trades, especially if we're holding for the entire 3-month duration. I understand that traders generally don't do that, but if they choose to, you can see that the expected value of your trades increases with the risk-to-reward ratio that you employ. Your simulated win rate is almost always 90% if you're working with a positive average drift like SharpEdge. Now, the expected value is not like eventually with a positive drift like this, if you're holding the premier portfolio, which I guess you can't do, you would have to choose a particular stock within it. So I guess I made some oversimplifying assumptions, but the point I'm trying to make is the only thing that can give you a strong advantage in trading is a track record of positive average drift, identifying those before they happen, or holding for a long period of time. You'll notice that even with a positive mu and you limit yourself to hold for 1 day, you will make no money. Your simulated win rate is 0, your expected value is negative every single time. So you need to be giving yourself one of 2 advantages. And that's maybe holding for at least a week at a time an asset that has a positive expected drift, which if we hold for a week, you can see that the expected value of your trades becomes positive for at least a little bit, all the way up until your risk to reward ratio hits 2.5. Great. But that's it. All I wanted to do was insert some of the performance metrics from SharpEdge into our trading model. So I can show you guys exactly how it can give traders an advantage, not just investors. I use it for investing, but I think it's a really good tool for traders and investors alike to identify movements that provide them an advantage before they ever even make a decision to begin with. So whatever strategy, technical analysis strategy that some people might be applying to the SharpEdge outputs, they are inherently going to be better than an asset that they haven't calculated the projected movement of, because they have these tools that are posted for free on the Sharp Education website. I hope this made sense to you. Let me know also where you want me to go with the application of this risk to reward program, because I'm really interested in it, and we also have a lot of content for our technical analysis indicators and ICT concepts. I'm not quite sure how to integrate them together quite yet to be most useful. So I want to hear your thoughts on what you would like to see me study using the information we have already. I appreciate you being here, and I appreciate you sticking around for the sales pitch, pretty much. I think it's super interesting. That's all. So, until next time, stay sharp.